Okay, hello everybody and good afternoon and welcome to this session called The Transformation of Finance. It promises to be a very interesting discussion. In fact, so interesting that there's almost a riot outside the door right now of people queuing up to listen to the bankers, which is great start. But we are indeed at a very, very interesting moment in finance. I've been coming to Davos since 2007, and I think there have been three phases in terms of the Davos debate about finance. Back in 2007, the first time I came, bankers were on top of the world. Everyone was in love with credit derivatives, financial innovation was celebrated, bankers threw great parties and held their heads high, and it was certainly a time when finance was booming. Then, of course, we had the crash. And for the past few years, most of the panels at Davos have been dominated by endless discussions about regulation, what went wrong, essentially bankers saying sorry or not saying sorry, and lots of discussion about what could be done in the future to make things safer. A very backward-looking, very inward-looking debate. What's interesting about this year's agenda in Davos, if you haven't poured through the program yet, is that there is barely a discussion about regulation at all. Thankfully, we don't have to worry about those wretched acronyms anymore. Instead, it's a much more forward-looking discussion about fintech, about the big changes that are sweeping through finance and potentially transforming finance in ways that are both positive and negative. Now, as someone who's a journalist and paid to be cynical, my day job is I oversee the Financial Times in North America. There's part of me that thinks, well, maybe this is just a new way to distract people from some of the underlying problems that still haven't been solved in the core of banking. Certainly, if you talk to bankers, their in-trays are still bulging with regulatory issues. Or you can say, actually, this is the real story. And while we've all been worrying about the backward-looking crisis in the last 2 years, we've been fighting the last war. In fact, the biggest challenge to incumbent bankers today is not the crisis and regulation, but the new players. Or you could say, actually, this is going to be what revitalizes banking and allows the bankers to suddenly become beloved by everybody, and maybe, just maybe, makes the bankers suddenly very fond of the regulators, because guess what? Maybe they're going to protect them from the new disruptive forces. Lots of change, lots of very interesting issues, and we have a terrific panel here to discuss it. We have two incumbent bankers, one incumbent insurance sector representative. At the very end, known to most of you as Tom de Swaan, who runs Zurich Insurance Group. We have in the middle, you can see John Cryan from Deutsche Bank, co-CEO, and next to me, in my immediate left, your right, is James Gorman from Morgan Stanley. But we also have an incumbent or a semi-incumbent who disruptor, not incumbent, a disruptor, semi-disruptor. I'm glad you didn't flounce off the panel in a fit of, yes, well, compared to some of the real startups, they may think of you as incumbent now. But anyway, a disruptor, Dan Schulman from PayPal. And of course, we have Christine Lagarde, who runs the IMF, who takes an overview of what's going on. So I'd like to start with a quick overview from Madame Lagarde. The IMF has spent a lot of time in the last few years looking at the financial crisis and what's wrong with banking. But today, you have something slightly different to unveil, don't you? Because the IMF has taken a slightly different role, a slightly different direction in terms of looking at finance. Can you tell us a bit about that? And tell us briefly where you see finance going in the next few years.
Ooh. Thank you, Gillian, for setting the agenda and a tough question. First of all, I think that your point about regulations is well taken, yet the entire regulatory environment is not completely settled yet, and there is still work to be done in various areas. I think the cross-border resolution is one of them, which has not yet been completely settled. And I think there are issues to be resolved between the US and Europe in terms of over-the-counter derivatives and clearing systems, which are not really exchanging information at the level and at the speed where they should. So in those two areas, at least, more regulation is still to be defined and agreed upon. 2 points. There are new ways of doing the regular traditional business. And for those of us who have kids or young adults in the family, you know that they don't go to a bank. They don't go to, probably many of them have not stepped into the branch of any particular bank, yet they do banking. But they do it in a different way, using different channels, using different modus operandi, which has nothing to do with interfacing with a person or with an account manager. And that's for the sort of retail basic banking, which is certainly disrupting the business of many traditional institutions, including some possibly in the room. There is a second point that I wanted to make, which is one where we have done a little bit of homework, and I'm saying on purpose a little bit of homework because it's the beginning of a process. And that touches on virtual currencies and the ways in which blockchains, technology, ledgers, can actually disrupt the business in a much deeper way than another way of doing the same business. And frankly, I'm saying that this is the beginning because we know relatively little about the virtual currencies. What we know is that they're not yet a major component. I want to give you the numbers because I think they matter. The current total market value of virtual currencies is about $7 billion at the moment. And if you compare that with US currencies in circulations, I mean, you know, banknotes, coins, it's about $1.4 trillion. And if you include US money supply, otherwise known as M2, you are talking about $12 trillion. So what we are talking about, these VCs, is really a very small compartment of the total currencies around the world and the total creation of money using different means. So it's still a small component, small item, maybe nothing to worry about. But just like so many things, you know, it's a bit like the tale of two cities. It was the best of time, it was the worst of times. Well, virtual currencies, you could argue, is extremely beneficial for the customers. It brings better value, it reduces costs, it provides financial inclusion, it provides versatility, it reaches out to places where people were not bankable, in some very far and remote places where technology is beginning to make huge entries. That's the best of time. Worst of time, it's a great instrument for crime, because a lot of it has nothing to do with central control, with the central banks, with supervision, with regulatory environment, and it's a very nice way, and people who look into how terrorism is financed will tell you a lot more than I would, but I've heard them. But it's certainly a potential instrument for illicit transactions, for money laundering, right, for terrorist financing. Equally, if it was to develop significantly, it would be also a potential threat to financial stability because it's completely outside the realm of regulated activity, and there are some tail risk scenarios that you could actually think of. Third, and we don't see that as a risk going forward for the moment, it could disrupt monetary policy. Too small to really be a concern at the moment. Our bottom line, and that's very preliminary because we believe that this scene is going to change massively going forward, but bottom line, just as we heard in 2008, the investment bankers who were just coming into the net of supervision and regulation didn't like it very much, but had to resort to it, saying to all of us, please look at the funds and see what the hedge funds are doing and why they shouldn't be included in the net. It might very well be the case that going forward, a lot of those that are regulated and supervised by virtue of what is defined as the banking activity, whatever form it takes, retail, investment, or more innovative, might very well say, please include them as well, and this go beyond the shadow banking, which is, you know, a bit more into the net of regulators and supervisors. You've asked me to be short, so I'll stop here.
Okay, well, thank you. Well, for those of you who'd like to read the entire report, I'm sure the IMF has got plenty of copies to hand out.
And it's available on the net as well.
Exactly. Or you can download it on your cell phones right now. So from Basel III to the blockchain, that's quite a big thing to span. Yep. But I'm curious, James and John, when you look at your inbox about what you are actually dealing with day in, day out in running big banks today, do you care about any of this electronic stuff, virtual currencies, or are you still fighting the last war and dealing with the regulatory onslaught from the last crisis? And what do you think are going to be the big forces shaping finance going forward? James, would you like to go first? Because you're nearest to me. I can jump on you easiest.
Thank you, Gillian. Yeah, we care a lot. We're in an industry that is driven by technology. And whether it was the advent of the ATM machine or the advent of the credit card or any of the evolutions and innovations of the last 50 years in finance, it's part and parcel of what we do. In fact, we had our earnings call yesterday. We focused a lot on what we're doing with our core businesses. The first email I got from one of our board of directors was about an article relating to fintech in the paper that day. And it was a healthy reminder that while we're talking to investors about what is in front of us, we have to have enough of a share of our mind looking forward to what might challenge us in the future or what might be opportunities. But you know, if you go back to the simple inbox, I'd love to say that the banking sector is kind of done with regulation. We know what the regulatory world looks like. We have a fully integrated global regulatory system. As Madame Lagarde just said, we clearly don't. That all of the rule changes that have been put in place over the last several years are finished. And I don't think anybody could say that that's actually the case. So in terms of inbox, we spend a lot of time worrying about regulation. The GSIB buffer, as an example, for the globally systemically important banks is a major new step that's coming down the track. TLAC, one of those acronyms that we're trying to avoid, has been something all of the banks have been adjusting to. So if you're not focused on how the regulatory environment can shape the kinds of businesses that you're in and dictate the kinds of returns you can expect from them, you're not doing your job. At the same time, if you're not focused on how some of these innovations are disrupting different parts of the financial system and how you can embrace them and use them to win business, not just defensively, then you're not doing your job. In our space, I mean, I think into the world of disruption, we've got obviously Dan from the payment sector, there's the credit sector, and then there's the investment sector. We'll come back to this, I'm sure, in the discussion, but I think there are very distinct challenges for each of those sectors and at very different stages of maturation, and that's largely driven by what the economic proposition is to the client by going entirely digital through payments, through credit, or through wealth management.
Right. John, how do you see it? I mean, when you look forward, say, 5 years, how do you think the banking sector will look? Do you think you'll have different set of rivals?
Well, I think we've always had to cope with new entrants into the various aspects of finance, which we as a bank at least prosecute. We have essentially three businesses. We have a traditional banking business where we take deposits. It's the reason why banks are regulated, is the taking of deposits, and people sometimes forget that. We then have a stockbroking business, which has borne the brunt of much of the regulation. Oddly, because the source of the crisis was actually just the extension of poor credit. And then we have a fiduciary business, which so far has been the business that has benefited, interestingly, from most of the legislation and rules that have been introduced since the financial crisis. They've generally benefited